On September 22, 1998, 16 people with 2 Nobel Prizes had 23 hours before losing $4.6 billion would destroy the global financial system. The smartest people on Wall Street had built the perfect money machine, and it was about to explode. 4 years earlier, John Merriweather had assembled the most brilliant financial minds in history. Nobel Prize winners, former Federal Reserve governors, mathematics professors who had revolutionized options pricing. The combined IQ of this 16-person team was higher than any hedge fund in existence. They raised $1.25 billion, the largest hedge fund launch ever. The results were spectacular. 1994, 20% returns. 1995, 43%. 1996, 41%. These were not lucky guesses. This was pure mathematical genius. Myron, Scholes and Robert Merton had literally written the equations that Wall Street used to price risk. Now they were using those same equations to print money. But genius needs capital to work. More capital meant more profits. By early 1998, LTCM controlled $129 billion in assets, with only $4.7 billion of their own money. That was just what appeared on the books. The real leverage was hidden in derivatives contracts worth $1.25 trillion, 250 to 1. For every dollar they actually owned, they had borrowed 250 more. In October 1997, Myron, Scholes and Robert Merton won the Nobel Prize in economics. Wall Street had never seen anything like this. 2 active hedge fund partners with the most prestigious award in economics. The press called them the Nobel laureates of Wall Street. Their Black-Scholes equation had changed finance forever. But equations only work if the world behaves the way mathematics predicts. In Russia, the world was about to stop making sense. August 17, 1998, Moscow. The Russian government devalued the ruble and defaulted on $13.5 billion in treasury debt, 5,000 miles from Greenwich, Connecticut, but LTCM felt it immediately. Their models assumed that government bonds were safe, that developed markets moved independently, that correlations would hold. Every assumption was wrong. August 1998 became a nightmare. Investors fled to safety. Japanese government bonds, US treasuries, anything guaranteed by a stable government. LTCM had bet against this flight to quality. They had bet it would never happen. Every trade went wrong at once. Bond spreads that had been narrowing for 4 years suddenly widened. Currency bets collapsed. Equity positions imploded. In 31 days, they lost $1.8 billion. 44% of their entire fund gone. September 22, 1998, Bear Stearns called $500 million, due immediately. LTCM had exactly $600 million left. One margin call, and the most brilliant hedge fund in history would be bankrupt. John Merriweather made a phone call that would change everything. He called the Federal Reserve. William McDonough, president of the New York Federal Reserve, had never heard of long-term capital management. That was about to change. In 24 hours, he would orchestrate the largest private bailout in financial history. Peter Fisher, the Fed's executive vice president, drove to Greenwich to see the damage firsthand. What he found in that mansion shocked him. The leverage was not 25 to 1, it was not even 100 to 1, it was 250 to 1. Peter Fisher walked through LTCM's Greenwich offices like a medical examiner. $1.25 trillion in derivative contracts, 36 different counterparties. Nobody knew how exposed they really were. Fisher called McDonough with a simple message. They're going to destroy the bond markets, and probably the stock markets too. This was not just a hedge fund collapse. This was a nuclear bomb in the heart of the global financial system.
While the Fed scrambled, Warren Buffett saw an opportunity. The Oracle of Omaha had been watching LTCM for years. He knew they were brilliant, and he knew they were reckless. Now he could buy the entire fund for pennies on the dollar. But here is what nobody talks about. Buffett did not want to save LTCM. He wanted to own their positions at fire sale prices, $3.75 billion for 90% ownership. And LTCM had exactly 60 minutes to decide.
September 23rd, 1998. Morning. Goldman Sachs delivered Buffett's offer in person. $3.75 billion, 90% ownership. The Nobel Prize winners would keep 10% if they were lucky. 60 minutes to accept, not 61, not 59 and 30 seconds, 60. John Merriweather looked at his partners, Myron Scholes, Robert Merton, the smartest people in finance, reduced to watching a clock tick down their final hour. The LTCM partners had built their fortune on mathematical precision. Now they faced a decision that no equation could solve. Accept Buffett's offer and lose everything they had spent 4 years building, reject it, and watch their life's work collapse in bankruptcy. Robert Merton would later say the crisis felt like getting hit by a truck. But trucks can be modeled. Probability can be calculated. This was something their Nobel Prize-winning models had never predicted: human panic operating faster than mathematics. 6 p.m., September 23rd. The Buffett deadline had passed. William McDonough gathered the most powerful bankers in America: Chase Manhattan, Citibank, Goldman Sachs, Morgan Stanley, 14 institutions in total. His message was simple: LTCM will file bankruptcy tomorrow unless you act tonight. When they do, they will take half of Wall Street with them. The bankers had helped create this monster. Now they would have to pay to kill it. $3.625 billion, 14 banks, 90% ownership of long-term capital management. It was not taxpayer money. It was not government money. But it was orchestrated by the Federal Reserve to prevent a global financial meltdown. The Nobel Prize winners kept jobs as consultants. No control, no equity. Just salaries to help unwind the positions they had created. Warren Buffett would later call it fascinating to watch 16 people with the highest IQs on Wall Street nearly destroy the world economy. It took 18 months to safely dismantle LTCM's positions. $1.25 trillion in derivative contracts, sold carefully, gradually, without triggering another panic. The banks that had rescued LTCM made their money back, and more. By early 2000, long-term capital management was dissolved. The smartest people in finance had learned the most expensive lesson in Wall Street history. But had anyone else? Myron Scholes lost millions of his personal fortune. The week after LTCM collapsed, he got married and joked about taking his wife's name. Robert Merton returned to Harvard. John Merriweather launched a new hedge fund, which failed again in 2009. The other partners scattered across Wall Street, carrying their mathematical models to new firms, new funds, new risks. The formulas that had nearly broken the world were still being used.
But here is what nobody talks about. LTCM was not an isolated failure. It was a preview. The mathematical models that failed in 1998 were based on only 5 years of data, 5 years of historically calm markets. The Nobel Prize winners had built their entire system on the assumption that the future would look exactly like the recent past. When the future looked different, their trillion-dollar machine exploded. This was not just about leverage. This was about the fundamental limits of mathematical certainty in human markets. The Federal Reserve had set a precedent. When the financial system faced collapse, the government would orchestrate a rescue, not with taxpayer money, but with private money organized by public power. Moral hazard. The biggest players could take unlimited risks, knowing they were too big to fail. LTCM's collapse should have been a warning. Instead, it became a template. The banks that rescued LTCM learned they could profit from both creating crises and solving them. 10 years later, they would apply this lesson on a much larger scale.
The LTCM crisis revealed that Wall Street had become a single, interconnected machine. 36 counterparties. Trillions in derivative exposure. No single regulator who understood the total risk. When one piece failed, the entire system nearly collapsed. But instead of addressing this systemic vulnerability, Wall Street doubled down. The mathematical models grew more complex. The leverage grew higher. The positions grew larger. By 2007, the global financial system was more interconnected and leveraged than it had been in 1998. Bear Stearns, the firm that delivered LTCM's death blow with a margin call, collapsed 10 years later. Lehman Brothers, which had participated in LTCM's rescue, filed the largest bankruptcy in US history. The same mathematical models, the same excessive leverage, the same assumption that markets would behave rationally. The Nobel Prize winners had discovered something more valuable than the perfect trading strategy. They had discovered the perfect way to destroy the global financial system. And Wall Street had taken notes. Today, mathematical models still drive trillion-dollar trades. Hedge funds still use massive leverage. The financial system is still interconnected beyond any regulator's ability to comprehend fully. Long-term capital management proved that the smartest people in any room can be wrong, especially when they all make the same bet. The Nobel Prize winners had solved the mathematics of option pricing, but they never solved the mathematics of human panic. Some equations cannot be written.
This wasn't our first satisfying disaster, and it won't be the last. Subscribe.